We are either in the beginning of a new uptrending bull market, or we are in the midst of a bear market and have experienced a typical bear market rally. Some call these a bear trap because they give a false sense of market optimism and suck in unsophisticated and unsuspecting retail investors. I believe we are in the beginning phase of a long-term secular bear market. According to Russell Napier, expert financial historian, long-term secular bear markets usually last 1 to 2 decades and have several shorter-term bull market cycles within them. Hi, I'm Ben Reppond. Today is August 23rd, 2022. Welcome to my YouTube broadcast. I'm going to show the perspectives of 3 different people. They're short clips, and they will speak to the question of where are we? Are we in a new uptrending market, or are we part of a longer-term bear market cycle? The first is Dagan Wright, and I'll play this and then make a comment afterwards.
You know, Frank, I agree with you because ultimately what I'm seeing is that this looks to be a bear market rally. And the reason I say that is we may have hit peak inflation, but the Fed has not signaled that they're going to stop the rate hike cycle because they want to focus and get to a target of 2% inflation, and we're not there yet. They also want to get a more balanced labor market, and we're not there yet. So they're going to continue to raise interest rates, and that could have a negative impact on stocks. So that's why I'm still seeing that we could pull back from these levels.
Dagan Wright points out that stocks will be coming back down because of the already announced Fed interest rate hikes. Next, I will play a short clip from Art Cashin. Art Cashin is with UBS. He's the director of floor trading for UBS and has been on the floor of the New York Stock Exchange, believe it or not, 50 years, and is highly regarded, sought after for his opinions. He gives a balanced view, but favors the view that stocks, in fact, are coming back down. Here's Art Cashin.
All right, Art, I'm perplexed, so give me what is perplexing you.
Well, I have to say that this bear market rally, if it is such, and I believe it to be, has certainly lasted longer than any of the rallies so far this year. The fact that we have gotten pretty close to a 50% retracement in some areas would favor the bulls. And in fact, that when you get there, it becomes a rarer event to roll back and retest the lows. Yet I still believe that that will happen. You will note that the year of an interim election, second year in a presidential term, the lows tend to come a little bit later in the year, probably going into September, mid-September or so.
And finally, I'll play a clip from David McIlvaney. David McIlvaney does a weekly podcast, which I listen to, and he's full of wisdom, in my opinion, and I appreciate his insights. The podcast is an audio podcast, so I'll play the audio clip. And again, McIlvaney presents another balanced view of is it going up or is it going down, but favors the view that stocks, equities are likely to head back down in the coming months. And he attributes this to low volume that we have seen in the last month or two, which is not typical of a new bull market. rally. Here's David McElvaney.
A true bear market is a lot further to run because nothing has been learned, and the lessons that needed to be learned are not remembered. And the second major phase of decline is what you would expect between now and year end. You could look for geopolitical predicates for that. You could look at a cooling global economy. You can look at a declining economic reality within China. What it suggests is that we're going to be challenged by at least one, if not multiple factors by year end.
I'm going to shift gears. This is on the website usdebtclock.org. You can look it up. It's tick by tick, spinning numbers. And I took this last week, and the national debt, the money that we borrowed, through the issuance of bonds, is over 30 trillion. Now, if I slip up and call it million or billion, it's because I have a hard time with trillion. Down below, at the bottom, this shows the total U.S. debt, not just the national debt. And the total debt is 92 trillion. Now, a country and individuals can support a level of debt. It's probably a good thing to have no debt or limited amount of debt, or in the case of individuals, where the individuals will have a mortgage, and that's a debt, but it's, supports a place to live. And if you don't pay that debt, then you would pay rent. So it's a case can be made for paying mortgage debt, yet some people choose to pay off that mortgage and have no debt whatsoever. The spending, the issue, that's how did we get to 30 trillion? Because in 1980, we had about $1 trillion of debt. And that has grown to 30 trillion. It was about 10 trillion 14 years ago. And here it is at 30 trillion. So we got there because we spend more than we take in. The second line shows that our spending is 5.9 trillion. That is offset by income, revenue, tax revenue, of 4.4 trillion, leaving a deficit of 1.5 trillion. That 1.5 keeps getting added to the 30 trillion. The thing that compounds this, in addition to us spending more than we take in, is the next to the last line, which shows that the interest on that debt currently is 442 billion. Almost $500 billion is going out in interest. As interest rates go up through Treasury rates, we know that the Fed's raising rates, and of course Treasuries tend to follow. The country, we pay that higher interest rates. We're not exempt from that. So the $1.5 trillion of deficit comes about because, in my opinion, of careless spending. Congress, as I've said in a previous video, Congress does not ask the question, can we afford it? You and I look at our budgets, and if we want something or need something, we look and say, can I afford it? Do I need to cut something here or there, or make additional income here or there in order to make sure that I can afford it? Or even sometimes save up in order to afford it. Somehow the federal government, and maybe all governments, don't look at it that way. They just spend with seemingly no regard for what does it cost us. Now, and by the way, this is true of Republicans and Democrats. I will show you both another slide coming up that will show through different administrations, it's the same problem. And also I'll point out that it's not just the U.S. It is other countries. So virtually every country, and certainly every developed country and most underdeveloped countries, have the same problem. Just a matter of degree. some a little more, some a little less. We're about 8th in the world of developed countries as far as our debt to GDP, gross domestic product, ratio. In other words, how much are we borrowing relative to our economic output? That is a way of that ratio is a way of expressing the severity of debt in a given country. So here we are, not just us, but other countries are doing the same thing. It seems that politicians can't help but handing out goodies out of the goodie bag. And this is the result, is just deficit spending until, and we have a debt ceiling. They hit the debt ceiling. I'll show you this in a minute. They hit the debt ceiling, and then they just do what's called a continuing resolution and say, we'll kick the can down the road, we'll raise the debt ceiling. Never do they stop and say, we can't afford it. We have a ceiling, we have a limit. No, just keep spending. China has been, for several years, has been paring back their holdings of U.S. Treasuries. This has been going on, this is the 7th month, but actually if you go back several years, I don't remember when, but I think 5+ years, between 5 and 10 years ago, maybe 5 and 8 years ago, they began selling off U.S. Treasuries. They were the holder or buyer of U.S. Treasuries, and now they have become a net seller, getting rid of the U.S. Treasuries on their balance sheet. At the same time, China, for 10 years or so, has been continuing to buy gold. They are the biggest buyer of gold in the world and have been for about 10 years. And India and Russia are right behind them. And so it's interesting. They're getting rid of treasuries. In other words, what do they know that we don't know? They don't like them. They're not backed by anything. They're just paper. And so they're instead selling those and are buying gold. This is a chart that goes back about 10 years to 2012. And this shows the increase in the debt over this 10-year period. You notice there are several things here. That the markers show debt ceiling. So we hit the debt, we borrow, and there's a debt ceiling, and Congress, that we hit that debt ceiling, and then Congress says, oh, okay, they do some posturing, but basically pass a law that says, let's just raise the debt ceiling. Interesting things about this chart. So you see these periods of time, these flattened periods, those are when we hit the debt ceiling, and then Congress comes to a stalemate and impasse, and then they eventually decide, yeah, we've got to keep spending. We've got to keep spending. So, and there they go. So you can see this has gone from about 15 trillion 10 years ago to over 30 trillion today. Do you see the magnitude of that increase? Now, when I go back to 1980, we had about $1 trillion. It took us all the way from the beginning of our country until 1980 to get 1 trillion in debt. Since 1980, in the last 40 years, we've gone from 1 trillion to 30 trillion. Now look at this. From March of 2020, the beginning of the pandemic, I put a box and a black line there to show what happened before and after that period of time. So before that period of time, you can see definitely going up and up and up. But look at what happened since that time. So that takes us to about 23.5 trillion in March of 2020 until today. So this is about 2 years and 4 months. And we have gone up about 7 trillion in 2 years and 4 months. And yes, we hit a debt ceiling somewhere in there, and then Congress just passed a law and said, let's just keep spending. I'm going to break that down into a shorter period. I'm going to take the last period of time from December of 2020. This would take us back to, a year and a half ago, a little over a year and a half ago. And this just takes the end of that chart. Could go back further, but this makes my point. You can see the level of deficit, or the debt, and how it has gone up over that period of time. And I put a black arrow through the middle of it, so it's sort of a regression line. You can see the direction. And yes, we hit a period in here where we had hit a debt ceiling, but after that, we just started spending more money. So the debt ceiling doesn't seem to matter. I don't know why we have it. But if they're going to ignore it. But so, yeah, about a $7 trillion increase in that period of time. So what can you do about this? Well, the way I look at it is what I can do is I cannot have debt. I can certainly not have consumer debt. And if you have consumer debt, work toward paying it off, primarily credit cards. And sometimes that's necessary at times for people, but if at all possible, pay that off. Mortgages, if you want to pay that off, you can. I would make a recommendation that if you don't pay it off, you have an equivalent amount of money available that you could pay it off if you had to, and you have an amount of money to easily support the mortgage payment. But consumer debt, I would definitely recommend diminishing or eliminating that. That's what we can do. Second thing we could do is we could demand of our politicians that they not spend more than we take in. If we take in X amount of dollars, why don't we limit our spending to that? You do that at home. I do that at home. I make sure that I spend less than I take in. Why can't we do that as a country? Why can't we do that at all levels of government? And why do we have to issue debt? And could we even, in addition to not increasing debt, what about if we just paid the interest? That'd be awesome. If we stopped borrowing money and started paying the interest, which is almost $500 billion, so we would have to take in about $500 billion more than we have in spending plus interest in order to pay the interest. So what if we did that? We would probably be, I'm thinking we'd probably be the only country or nearly the only country in the world that did it. What an awesome thing that would be. And we could stop at the 30 trillion and start working our way back down. That's just the way I think. Maybe I'm old-fashioned about it, but I just think the idea of having debt doesn't make sense. I don't care if you're a household or if you're a country or a county or a state or whatever. Just living within your means seems like a reasonable concept. Okay, I'm going to play this a very short clip here. It describes the impact and the magnitude of debt, very brief, and it's a good explanation. It comes from the CME Group, and I'll play it for you.
In the 2 years since the onset of the pandemic, the national debt has ballooned from $23.5 trillion to a current level above $30 trillion. Oddly, the cost of debt service per year during that time actually declined due to the accompanying ultra-low interest rates. In 2019, the federal government spent $404 billion to service publicly held government debt. In 2021, that number dropped to $392. Now that rates are rising, however, things are changing. According to the Congressional Budget Office, if interest rates rise by 100 basis points or 1 full percentage point, average annual interest costs would increase by $187 billion. Fortunately, periods of higher inflation, like we are now experiencing, tend to increase federal tax receipts. But those numbers are more difficult to estimate, and most analysts believe that the total will be inadequate to offset the increased costs. The potential problem would be if the current aggressive Fed tightening is complicit in causing a recession at the same time debt payments are increasing. This situation could probably force governments to seek more aggressive ways to raise revenues and could add to the negative economic impact.
Okay, switch gears. Some of you know this. I teach at the local college, Flathead Valley Community College, in the continuing education, the adult education evening classes, classes on investments. This year, they and I have decided to offer a course on maximizing Social Security benefits. And that starts next month in September. So if you happen to be in the Flathead Valley and want to take that, you can check the catalog. I've been studying a lot, trying to build a knowledge base that at the level that would allow me to teach it. And so I'll make a couple of comments as I get closer to the class time, or maybe around the time I'm doing the classes. I may do a segment on YouTube that would be a more extensive segment, but I want to mention a couple of things. If you have not yet taken Social Security, which means you're under age 62, generally speaking, I'm not talking about survivor benefits, but if you're a primary worker and you have the opportunity to start taking at age 62 and you're that age or less, then you will be faced with the decision, when do I start taking Social Security? 62, 65, 67, or 70. You have to start taking it at age 70. And benefits go up the further you delay it. The people know that. And so as I talk to people, I find that they are aware of that concept, but they are not aware of the fact that, or of the question, when do the lines cross? When is it more to your advantage? In other words, how long do you have to live? So that if you delay taking it, you actually make more money than if you start taking it earlier. Sometimes people have to take it earlier, they need the money, but a lot of times I see that people don't necessarily need it, and there's a benefit in deferring the taking of it. If you do that, you get more benefits and the compounding of more benefits for the rest of your life. And there is a point where that becomes more. So I don't find that people have done that calculation. So I have a calculator that has all the rules built into it, and that will actually graphically show the benefit of taking it early for a period of time and then the benefit of delaying it. The other thing I'll comment on is that if you are a spouse, and let's assume that this is generally true, it's not always true, so I'll say it's true most of the time. The spouse of the primary worker is typically the wife and is typically younger than the husband or primary worker. Oftentimes, both of them will have a Social Security benefit. When the spouse, the wife, in this example, gets to age 62 or 67 or 70, has the opportunity to take Social Security, then they begin taking it as a primary worker. However, they also qualify as a spouse for the spousal benefit. And even if you've already started taking Social Security and later on you have the opportunity to claim the spousal benefits, and if those spousal benefits are greater than what you would get as a primary worker, you can switch and start taking spousal benefits instead. Sometimes people don't know that. If you have an ex-spouse, you've been divorced, and a certain number of years ago, you also qualify for a spousal benefit from that previous spouse. And is that amount greater than what you would get yourself? Oftentimes it is. And you can switch and go to the higher benefit. And finally, if you are a survivor, you have a spouse or ex-spouse who died, and that you get a survivor benefit. That benefit, if it's greater than what you would make on your own as a primary worker, again, you can switch. The calculator that I have has all of the rules built into it. I didn't create the calculator. I licensed the calculator. And it has all of the rules built into it. So I'm able to take a person's situation, the facts of their benefit and their age and marital status, previous marital status, etc., put all of that in the calculator and run different scenarios. What if you start taking it now or at a future date, or you switch? It's called scenario planning. And so it will tell you which situation you're best off in to get the maximum benefit. So if that is you, and you want me to run that calculator for you, I will do that on a complimentary basis. I would not charge you for it, and there's no catch. I'll just do it for you. And then I will give you the written report, and you can see for yourself the calculations and what the different scenarios would mean, and hopefully that'll be helpful. If a lot of people contact me and ask for this, the only downside is I may not be able to get to you right away, so it may take me a few days, and I will certainly give priority treatment to our clients. So more on that later, but I just thought I'd mention that because I find that a lot of people are not aware of these different scenarios and how they can maximize benefit depending on the kinds of things that I discussed. Okay, change subjects. The flow of funds report came out last week, and it shows this is where is money going, measured on a weekly basis. So conventional equity funds had net inflows coming into equity funds of $7.3 billion. Conventional bond flows had inflows of $5.7 billion. And money market funds had inflows of $3 billion. So that tells you where the money's going. Okay, I'm going to go into the dashboard. I'll show a couple of dashboards with like this. These are through Friday, August 19th. And you can see these are 6 major indexes. The Dow Jones, the S&P 500, IWM is the Russell 2000 Small Cap Index, EFA is the Developed Countries ETF, and EEM, the Emerging Countries ETF, and QQQ, which is the NASDAQ 100. So they are in descending order based on rate of return year to date. So in the, right before the dots, the green dots and the red dots, right before that is the year-to-date change. And so you can see that all of the averages through Friday are down. The Dow, DIA, is down the least. It is down 7%. SPY, S&P 500, down 11. Small cap index down 12. The developed countries down 17, emerging markets down 18, and the NASDAQ 100 down 18. You can see the dots on the right. The 4 columns are the 20, 50, 100, and 200-day moving averages, and a green dot indicates that they are, that index is above that moving average, and the red or pink is, changed to pink because you couldn't see the red very well. The emerging markets and developed markets are nearly all below their moving averages. So the U.S. markets, measured by those 4 different indexes, are stronger than the foreign markets. And then the S&P 500 has 11 sectors. These are the 11 sectors, again, measuring from rate of return in the, I guess, the 4th row of numbers. Rate of return year to date in descending order. The best rate of return is XLE, which is energy, which is up 43%. You know that from what the your bill is at the gas pump. And the worst is XRT, which is retail, and next to that is IYZ, which is telecommunication. And they are down 23 and 19%, respectively. And most of them are down. The second one below energy is consumer staples, and it's almost break even for the year. It's down a fraction of a percent. I'm going to show you some weekly charts. These are interesting because, and they're through Friday. The market was generally down for the week, this past week, and I think this will, several things I want to point out here. This is a one-year chart of the S&P 500, and it shows the 1 week equals one movement in the chart, and then a 20-period moving average is cutting through the data. It's above the 20-period moving average, and you can see that from the previous chart as well. But look, and I did a black arrow showing the current trend. The trend is generally upward, but at the end of that chart, you can see the downward move because it was a down week. That represents 1 week of the S&P 500 relative to the previous weeks. So we don't know what's going to go beyond that, but I can just tell you that's where it is right now. When we develop a ratio of growth stocks inside the S&P 500 and value stocks inside the S&P 500, those are measured by the ETFs SPY-G and SPY-B. SPY-G, growth stocks, are the numerator and SPY-B denominator. So in other words, if the line is moving up, that favors growth stocks, the growth portion of the index. If it is moving down, it favors the value portion of the index. So you can see from actually about mid-November that until today, that the red line shows that it is generally in a downward trend, and there are moves up and there's moves down, but in general, it's a downward trend. The black line shows perhaps the beginning of a new trend or a bear market rally, that this rallied for a while and it will die out. And you heard the comments, pro and con on that. I do the same thing with small companies versus large companies. Small companies are measured by the small cap index, IWM, which is the Russell 2000 small cap index, ETF, and that's the numerator, and the denominator is the S&P 500 measured by SPY. This is a 24-month chart, not a 12-month chart. So I wanted to do a 24-month to give you a perspective. So the black line shows you that in general, that the large cap companies are in favor. So that shows you the degree to which the small cap companies, the smaller type public companies, are out of favor relative to the S&P 500 and pretty much continue to be out of favor, even though it is barely above its 20-period moving average. Long-term government bonds. This is a 30-month chart, so this is 2.5 years. I did this so I can show these periods of time, and you can see that that the first black arrow down on the left is a long period of time where bonds are, and this is not relative to anything, this is just the long-term government bond. It's not short-term, it's not intermediate term, it's not corporate, it's not high yield. This is the long-term government bond. But the intermediate and short-term tend to move in the same direction. They just move with a lesser degree of magnitude. So definitely down. And then you can see about the middle of the chart, there was a rally. Oh, things are getting good again. rates are coming back down, perhaps, and the bonds are going back up. Not so quick. So you can see the black arrow on the right showing the direction since about the 1st of December of 2021. So for about 8 or 9 months, you can see the direction, and it is continuing to stay below the moving average and move in a downward direction. And this is because the raising of interest rates by the Fed and the anticipation of future raises by the Fed, in my opinion. So this is part of, government bonds are part of, and sometimes an integral and important part of, traditional portfolios, investment portfolios. And this is why they have had such a hard time. Traditional investors, traditional financial advisors have had a horrible time this year because they have relied on this as a safety valve for stock risk. So as stocks would go down, bonds tend to go back up. Didn't happen. And what is the future? I think if we're in a long-term bear market for equities, there will be periods of time where, I'll call it a head fake, where these will go back up just like they did last year, and then they will turn around and collapse again. We don't know for sure, but I'd say the future of bonds is not very positive, at least at this point. I think there will come a point when rates get high enough so that the only alternative, like 1982, the only alternative at that point is that the interest rates are going to go down, which means bonds are going to go back up. But we're a long ways from that, it appears. So the next is gold. This is a 12-month chart, a weekly 12-month chart, and you can see that since April or so that the direction of gold has been down. When I switch to silver, same thing, maybe a little bit more so, 12-month chart. And then I push this out to a 24-month chart as a ratio. It puts silver as the numerator, gold as the denominator, measured by the exchange traded funds, SLV and GLD. And you can see that silver relative to gold has been more out of favor. So gold has, percentage-wise, has outperformed silver during that period of time. The volatility index has gone down. The last week, as I've said before, last week we saw a decline in equities in general. You saw that. Well, that is measured when you see at the far right corner, you can see that tick up in the volatility index, and that represents an increase in volatility in the market. And it's not a major move up yet, but that it had been going down for some time. So now it's we'll see what happens in the future. Okay, Asbury Research produces numbers. These are through Thursday, the 18th of August, and all 6, as of that date, were positive. I suspect at the end of Friday that is going to change, but I don't have those numbers yet. And then this is dated. This chart and the next chart are dated. They're a week old because I do the broadcast before they update these. So you can see, same as last week, equities, growth equities, NASDAQ over the S&P, U.S. over foreign markets, corporate bonds over government bonds, and high yield over high quality bonds. So I will update this next week. This same as I did last week, which is the showing really the U.S. is in favor, but not enough to get a green box. So they're slightly favoring the U.S. over other markets. Gold is, as of Thursday, the price of gold was $1,762, down 2.4% from the previous week, and silver $1,956, down 6.2% from the previous week. You recognize who this is. This is Chancellor Angela Merkel from Germany. She served 16 years as Chancellor and just retired this year. And I saw this image and I thought, boy, that's a different image. And this is her pushing a grocery cart. She's doing her own shopping. So I did some research into this. What is there about her doing her own shopping? She shops at the same supermarket and has for years, and she does her own shopping. Who is Angela Merkel? She's probably the most influential, has been, the most influential and powerful person in Europe. And Germany is the strongest country, probably, in all of Europe. And she has been in that position for 16 years. I don't have to explain to you who Germany is. And at the end of her day, at the end of her week, after putting in a full day at the office, she goes by the grocery store and does her shopping. It is said that she does this all the time. They're used to seeing her, and she prefers to live the life of an ordinary person as much as possible. It went through my mind, what if our politicians did this? All of them. Instead of, flying around on jets and living this life that's above all of us commoners, what if they did that and saw themselves as an ordinary person and did things like doing their grocery shopping? It just would seem like maybe the country would be a little different. And by the way, as I was researching her and looking at her background, I found that she speaks Russian, fluent Russian. So when she has negotiations with Vladimir Putin, they do it in Russian. And she has a PhD in chemistry. I thought that's interesting. And her father, by the way, is a Lutheran pastor. She said in one of her quotes, she said that she's a Christian and a devout Christian, and she said her Christianity and her belief in God is a big part of her life and is impacts her decision-making as the head of the country of Germany. Here's some exact quotes I wrote down. She said this: "I will not let anyone tell me we must spend more money. This crisis did not come about because we issued too little money, but because we created economic growth with too much money, and it was not sustainable growth." Well said, Chancellor Merkel. And she said, "Neither the chains of dictatorship nor the fetters of oppression can keep down the forces of freedom for long." I thought that was interesting. Thank you for watching. If you have comments, leave them below. As I said, if you want me to run some scenarios for you on Social Security, I'll be glad to do that, particularly those that are spouses or ex-spouses or surviving spouses. Those are helpful, I think, scenarios for people to look at. And feel free to reach out if you want me to do that for you. And thank you again for leaving comments, and thank you for watching.